a bunch of stocks where we met with the management. They're administrators. They're not leaders.
But it is highly volatile, as you said. Like,
continually needing to raise capital works until it doesn't.
uncontrolled dilution is the biggest risk for small cap investors. Hello, everyone. It's Harold Leishman, Senior Investment Advisor with CG Wealth Management and one of the founding partners of LLC Private Wealth here in Vancouver. Today, I'm speaking with Donville Kent Asset Management, one of the best known and preeminent small cap funds in Canada, to get some of their perspectives on some of the past history for small caps and where we think we might be going. After several extremely difficult years in small cap land, some of these small cap stocks are starting to have some pretty big bounces. It's been predominantly focused on companies with growing revenues and cash flows. Now, Jesse Gamble and Jason Donville, thanks for taking the time to speak with myself and my clients. In one of your more recent letters, you've reflected on how the extreme economic events over the last couple of years have affected small cap stocks. We had the pandemic, of course, massive global supply chain issues, and more recently, the fastest growing interest rates in recent history. And while I'm sure I know for a fact, it's been very difficult for small companies to deal with these macro winds. As a stock picker, it also makes it extremely difficult to get past all of that noise and kind of find the key pieces or key kernels of information that you want to focus on to pick the stocks you want to invest in. Can you tell us a little bit about your approach and what are the key elements you like to focus on?
Yeah, well, thanks for the introduction. And maybe before I get into the approach, just you talked about sort of the difficulty of small caps for the last couple of years. But if you look on a 25, 30-year basis, you get a cycle. About once every, you get sort of 8 good years, and then you get a couple of tough years, and then you get eight good years. And we argued in previous newsletters that the next positive cycle started at the end of October. So we're into the year 1 of that cycle. And each trough, every time we have a trough every 10 years, it's a confluence of a number of events, right? Whether it's a slowdown in the economy, rising interest rates, whatever. And that's what we saw in that period of sort of 1920 or 2021 to 23. There was a confluence of events. But where we found ourselves at the end of last year was valuations were at the absolute low end of the historical range when you look at it over 20, 30, 40 years. The stocks were growing. Interest rates were high, but not likely to go dramatically higher. And if anything, they were either going to go sideways or go lower. Certainly back in October, November, we thought interest rates would go lower. And in the case of Canada, we still think that's going to happen. So, which means that there's some currency implications if the Canada lowers interest rates faster than the States. So the bottom line was we set up for a cycle. Oh, and then the last thing is all the institutional money was out of small caps. So there was no incremental sellers left. The only direction that was going to happen was people coming back into small caps. So, this sets us up for year 1 of what will probably be a 6, 7, 8 year cycle. And then something will happen 8 or 9 years down the road, and you're going to get, knocked to the pavement again. And that's where, as you get into your 4, 5, 6 years into your bull market, you've got to be careful of what you hold going into that trough that ultimately comes. But from the point of view of investors, this is the timing now is right. So now if I can pivot into what kind of companies are we looking for?
Yeah. So what are the key pieces that you look for if you can summarize it in sort of?
So we're looking for compounders, right? So we're looking for stocks that let's say can grow at a consistent 15% a year or better year after year after year. And to be a compounder, you typically have a couple of things working in your favor. Well, number one is you've got a margin that allows you to have profits that you can reinvest in next year's growth. So it's very hard to find compounders who are at break even or below that, because they're not generating enough cash flow to fund their business. So they're going to have to keep coming back and raising more money. And once the market figures that out, they don't want to give them any more money unless the company's super exciting. So you've got to be able to generate the capital that grows your business going forward to be a compounder. Second of all, management's got to have a philosophy that they understand that if we're going to grow 15% more next year, we have to have a plan, which means we've got to have 15% more employees, 15% more desks, 15% more customers, clients. that general management. And that seems obvious, but there's a lot of companies that are more administered than they are led. They really don't have that planning in place. They just kind of wake up each day and deal with what comes in the door, right?
Wait for the phone to ring rather than
Right. And so
make the calls out. Yeah.
right. So the great companies have always got really concrete plans. And we can tell you, we don't want to mention their names, but a bunch of stocks where we met with the management. They're administrators. They're not leaders. They're not leading this business. They're just dealing with what comes in each day. And at the end of the year, their growth is up 3% and their margins have changed a little bit one way or the other, but there's nothing dynamic or exciting about it, right? And then the last thing is they got to have a product or service that's relevant, right? So that's the other thing you got to be a little bit careful in a technological age is that some products and services can change very, very rapidly in this marketplace. And an example would be advertising technology. And we talked a little bit about this before we started the call, is ad tech changes really, really rapidly. So the thing that worked as far as getting customers or getting people to pay attention to you 5 years ago is continuously shifting. So you've got to stay on top of your companies to just make sure that they're relevant. And if they're not relevant, it'll be reflected in their sales numbers and in their margins.
I know we've certainly looked in our shop. We've looked at a lot of these ad tech companies that are publicly listed, and some of them can seem really cheap and growing fast, but it is highly volatile, as you said. Like things can fall off pretty quick.
Yeah.
Which makes it which can make it a challenge for sure.
Yeah, Harold, to your point about kind of, the pandemic and all the issues and, how to handle that and why compounders kind of worked is, continually needing to raise capital works until it doesn't, right? So that's why we've focused on companies, like Jason said, that have a consistent, steady cash coming in the door, because what we say is, they control their own destiny. The market doesn't control their destiny. We don't invest in commodities, so that commodities don't control their destiny. They really control what they get to do, right? So they have cash on the balance sheet, they're not over levered, and they have cash coming in the door, which leaves them in a strong position. So, a lot of those small caps got hit across the board, every single one, even if they were having record revenues, record earnings. That was like a whole segment sell-off. So that was where kind of maybe stock pickers can kind of come in and say, no, this one's unfairly punished. This one never should have been up that high in the first place. And that's where they're kind of, trying to find quality in times like that. So then when we do turn the corner, like we think we're doing now, those are the ones that really rebound quickly.
Yeah, uncontrolled dilution is the biggest risk for small cap investors, and 95% of the market suffers from that in Canada anyway.
Yep.
I guess as a follow-up question, Jesse, so post pandemic, the quantitative easing, the liquidity that came in, drove valuations to extreme highs, and then as Jason said, more recently they've been at sort of extreme lows. And so how do you kind of pick a mark where you figure out what fair value is, given that if you're just looking at historical averages, you've got such extremes in recent history?
Yeah. So the thing is we don't really look at kind of, what it used to trade at or anything like that. Is, we build our models in-house and we have a valuation discipline. So there's a few names that we can talk about in Canada where they're great companies, like compounders, but we've never owned because the valuation's too high, right? So you can love a company, you can and then not love the stock, right? So there's really good compounders, but you need to have that valuation discipline, which is why when things were going crazy with the monetary policy and COVID stimulus and et cetera, you can't get caught up in that, because you have to have some type of discipline, some type of system in place, right? So we have a system in place, and we try and stick to that system because we believe it works.
Fantastic. Now, Jason, you talked about compounders, and I know, Vital Hub is a name that we owned. I know you obviously own a lot of it.
Yeah.
And it was one that, we saw under $3, and you could see the earnings starting to grow, and the management was talking about, hey, like, we're becoming a compounder here. The cash flows are starting to spit off, and we'll be able to use those cash flows to buy additional businesses as well as keep the organic growth up. And so one of the questions I have is, how do you manage a position like that? For us, we were overweight for quite a few of our clients, and the stock has a big move. And, as a broker, you tend to want to manage people's positions so they don't get crazy out of weight. But it's so hard to find really good quality compounders like that, that you know, if you sell it, what are you going to replace it with? This becomes kind of the conversation we have. So
Yeah,
how do
so
you guys do that?
yeah, so we've always got eight or nine good core compounders in the portfolio that we can kind of adjust on, right? So for us, like Jesse actually manages the day-to-day minutia of the portfolio, right? But we're always like somewhere between 95 and 105% invested, right? So if Vital Hub shoots up or Propel shoots up and we trim, we can deploy that pretty much into another 8 or 9 compounders.
Right.
Then beyond those 8 or 9 compounders, we have let's say another 10 or 15 positions which are, for lack of a better word, emerging compounders. Ones that are showing all the characteristics, but they haven't got the track record to prove that they're going to become compounders, right? So there's always places there for that. So for us, it's pretty rare for us to be in a situation where we sell $1 million of a company that's shooting up and therefore overweight and not being able to find a home for it. Because, like, for example, if we had excess cash, I think Constellation Software is always a safe place. I think this company will grow at 15 to 18% a year for forever. And if you can get a 15 to 18% annual return from your portfolio, you're going to be doing great, right? So
Absolutely.
I think Constellation's a great place to park money. I think Go Easy is another one that we have where I think it gets battered around because of headline risk, but the underlying performance of the company is excellent, right? So depending on how fluffy or how up there it is and the valuation reasonable, we can always put money into Go Easy. And we've got like 7 or 8 of those kind of names where we're just very comfortable to add to our position.
Right.
Yeah. So
And I guess
sorry, to that point, Harold, like, Constellation we've owned for 15 years, something like that, right?
Yeah.
And it's Canada's best performing stock. So we continually trim. And that's, well, what do you buy into? And that goes back to the process, right? So Jason and I have our stock tracker saying, like, what looks most attractive these days. And so you're always trying to optimize, right? So if you're taking a bit from here, that, these 2, 3, 4, or 5 names are most attractive coming up, right? So it's just kind of that iterative process of recycling.
Yeah, and you talk about Vital Hub, and Propel's been another one that's really rocketed recently, more so. And we talked about it. We had a full position in Propel back in October, November when it was trading at $6.50, $7. It's at $23 today, right? So we've been selling this thing probably since it was $13. And then it goes up another $5, and then it goes up another $5. Like, we just continue. Like, it's sometimes when you get them right, it catches you off guard how fast they will go, right?
well, especially when you're coming off such an extreme low on the bottom, right? I mean, there's no
But
sellers left, and it just
I was at a Christmas party, and interestingly, there were executives there at Christmas from Vital Hub and from Propel. And I was saying to the guy from Propel, that was at Christmas time, the stock's on 12 or 13. I said, this stock's got an 18 handle on it all. Like, like a year from now, this is going to be an $18 stock, right? Well, by March, it was a $22, $23 stock, right? And we're kind of going, like, in relation to how financials trade, Propel's not cheap now. Propel has got a premium valuation now. Now, we haven't sold all of our position, but this is not where the value is. The value is elsewhere now. It's shifted because, but I think Vital Hub is still pretty attractive because there's a lot of capital there now that hasn't been deployed into acquisitions, right? And I think the forward multiples will come down very, very quickly once they deploy that capital.
Right. And I hear that they're planning on getting that done this year, or a significant portion of it. But
Yeah, so they
that's a whole
intimated
other
they got a big, they're looking at a bigger deal and a couple of smaller ones, but these things fall through, and the valuation of the market change people's mindset. So
Sure.
So while they're good at keeping us in the in the loop that they're working on stuff and that there's a lot of optimism, these aren't closed deals at this point in time, and the Shens who are on the board, very, very valuable members of their board, but they're also they're pretty stingy acquirers. They're typically they're very focused on buying as cheaply as possible, and sometimes the seller just kind of goes, hey, I'm going to go talk to somebody else because you guys seem great, but you're not willing to pay enough, right? So,
right.
And you're sitting here, and now we're May 1st, and we still haven't had an acquisition yet this year, right? And we've been hearing since January that they're imminent, and still nothing's happened. So it'll come, but
there's risks to every approach.
Yeah, and then sometimes you think some things are really, really good, and at the last second, something shakes out of the due diligence, and you go, oh, wait a second.
Yeah. Excellent. Well, listen, I really appreciate both of you taking the time to chat with me, and hopefully we can do this again sometime in the not too distant future. Always appreciate gaining insights from some of the best minds in the space. Thing about small caps is there's a reasonably small number of people that are focused on small companies with cash flow and growth, and so it's great to be able to exchange notes and compare ideas. So thank you very much, both of you, for taking the time. And yeah, we'll
Okay,
talk to
and
you soon.
thank you for having us today, Harold.
Awesome.
Yeah, thank you,
Richard.
Harold.
Thanks,
Appreciate it.
Jesse.
Bye.
All right.
All the
Bye.
best.